All right, so now we're going to continue with our discussion about the Greeks. I mentioned the last time that the delta and the gamma are really the more important of the ones that we'll be looking at, but the last three here are also important for different reasons. And I did actually mention last time that there are other Greeks as well. We're just looking at the five basic ones. But if you go to Wikipedia, they have a nice little article here about the Greeks. We have to be careful. I just realized that it thinks of me like Homer and Plato. No, what's, I would hope if I can touch it right. Okay, you're right. So they have an article in here where they have a nice little chart. Now, but here it is. This is what I was talking about. Now, the ones we're looking at are delta, gamma. In other words, the sensitivity of the options price with respect to the asset price, the second derivative of the options price with respect to the asset price. And then the ones we're going to look at now are theta, which is telling us how sensitive the options price is to the passage of time. Then we're also going to look at vega, here it is, which tells me how sensitive the options price is to changes in volatility. And then finally, we have rho, which tells us how sensitive it is to changes in the interest rate, which I just noticed now they don't even have it here. Wow. Um, they, in the meantime, Wall Street, that is, has come up with all these bizarre variations of the Greeks. Some of these, like look at this one. This is data with respect to volatility. They've come up with the name Veda. Gamma with respect to time is color. I'm not sure who's in charge of choosing these names. Oh, look at this one. Gamma with respect to S is speed. So, don't worry about those. Those are very strange, very bizarre. I guess there's some level at which they might matter, but these are the important ones right here, the ones we're looking at. So, and they're all either first or second derivatives of the options price with respect to the main factors that determine the price of an option, which if you remember, the big five variables we have are, let me write this down real fast. The call price is a function of the asset price, strike price, volatility, time, and the risk-free rate of interest. And the same thing is said is true for puts. What is different though is the actual results of these calculations in most cases are a little bit different. And in some cases the signs are different, but they're both functions of the same exact factors. Okay, so there's the Greeks that we're considering today are essentially partial derivatives telling us how much the option price is impacted by change in one of these variables, holding the others constant, and that's why it's a partial derivative. All right, so the ones we already looked at were delta. The delta of a call is this change in the call price with respect to the stock price. And then for the put, and so the one thing we do remember is that this one is strictly positive, this one is strictly negative, and they're tied to each other in the following way. Where delta C is, if we subtract one, that'll give us delta P. And then gamma, remember we're using the uppercase gamma, which looks like a backwards 7. This is this one that has the unusual property that it actually is the same for both calls and puts. So it was the second derivative of the call price with respect to the stock price, or the first derivative of the call delta with respect to the stock price. And the same thing's true for the put gamma. And so we know that both of them are positive. And for the same option, they're always equal to each other. All right. And actually, while we're at it, we might as well draw some sketches here. Um, Remember the way they work. Actually, let me go revisit the graph to make sure I'm doing this correctly. Um, I don't want to draw anything that's not correct here. Hold on one second. So this is, by the way, this is section 6B. Just want to double check and make sure I'm doing this correctly. The graph that we were looking at, actually, this graph shows us how the delta is calculated. In other words, it's the slope of the market price curve with respect to the, if you notice how here we have dollars on the vertical axis, S is the spot price of the asset. And what the showing the red line is the payoff to the call option. The black line or black curve, I should say, is the market price at any time prior to the maturity date. And if you notice, it's a little bit smoother, let's say. It's not a piecewise continuous function with two different slopes. It's a smooth continuous curve. The delta or slope starts at zero, and as S increases, it gradually increases and gets very close to one. On the final day of trading, the two curves will coincide with each other, and the option will either finish in the money, at the money, or out of the money. The put, it's facing the opposite direction, so the deltas are all negative, but it's the same type of logic. The delta tells me how sensitive the price is to the change in the underlying asset. What's different is that because the put is the one that gives us the right to sell an asset, we benefit when the price goes down rather than up. Okay, but we also saw a graph here. Here it is. This is what I was looking for. So the delta is on the vertical axis. Now the call delta, if you notice, goes from 0 to 1. You can't go outside that range. And this is why, because again, looking at this graph real fast, on the final day of trading, the market price curve and the payoff curve, the red one, will coincide. Remember, this is the payoff. This is the market price. As time evolves, the market price drifts to the right. It gets closer and closer to the payoff. And on the final day of trading, they will be exactly the same. And so you can see that it's not going to be possible for the slope of that market price curve to be negative or greater than one. It can't be steeper than the payoff profile. So we know that the delta is bounded between 0 and 1. Okay, now also just as a side note, if you remember that on the in the Black-Scholes model, delta, the call delta is approximately equal to ND1. ND1 is a probability. So therefore, it must again be bounded between 0 and 1. So the put is exactly the opposite in the sense that when you take the call, you subtract 1, you get the put delta. The slopes are always negative, and again, they get closer to the payoff curve. So the put delta is bounded between 0 and -1. And also, just terminology wise, don't forget that we've been using this terminology. Down here, we're out of the money, meaning that if we exercise the option down here, we'd have a negative payoff, which we would never do. Right here at this 1 point only, we're at the money. And out here, we're in the money, which means if we exercise the option, we'll have a positive payoff. And of course, that works in reverse for the put, right? Here we're at this part doesn't change at the money. All this section here represents being out of the money. And then of course down here we're in the money. All right. So again, so this graph, as I start to show you again, if we were to take, let's say, an option and recalculate delta at every possible level of S, this is the result. Okay, you can see it's an S curve. And this is what we're using, by the way, to calculate the gamma. The gamma is actually the slope of this curve. You can tell because it's always positive, but right about here is where it peaks out, basically. The rate of change of this curve is it's flattening out, it rises, and then it starts to slow down again. So anyway, this is where the gamma will be reaching its maximum. And that's what accounts for the graph. As you saw last time, it looks something like this. This is the strike price. Okay. And that, of course, holds true because while the signs are different, the slopes are the same because they only differ by a constant. Okay, remember that delta P is nothing but delta C minus 1. So therefore, the slopes have to be the same. And so here, we get the maximum gamma. Okay. So, oops. Looks like the label is backwards. And then, keep on, this is 0, so these are all positive. These are all negative. And of course, this one can't go below -1. All right. So these graphs are not, these long graphs are a little shaky, but you get the idea. Okay. All right. Anyway, and then of course this leads us up to, oh, and by the way, these curves, remember, all they will show us that as time elapses, eventually the options delta has to be 1 if we're in the money, 1/2 if we're at the money, and 0 if we're out of the money. And the reverse is true for the put. This just reminds us how to adjust our formulas if we have if we're pricing an option on, let's say, an asset like a currency that provides interest to the owner. Then we have to use Merton's model instead of the original Black-Scholes model. And one of the consequences of that is that the Greeks need to incorporate this term e to the minus qt. The q is the continuously compounded yield of the underlying asset, whatever it happens to be. If this is a non-dividend paying stock, then Q is just 0 and it reduces to the original Black-Scholes formula. So contingent compounding yield to the asset S. All right. So in other words, if let's say you have you're writing an option on the British pound, the British pound owners of the British pound will collect the British rate of interest, which would be treated as a continuously compounded rate, and so Q would be the British rate of interest. Okay, and so that's how this would work. And of course, that has an impact on the rest of the model. So here's a gamma, which we've already discussed. And here's the curve. And so basically what this means is, as a trader, here's one of the consequences of gamma. If a portfolio set up, let's say to be delta neutral, which means the delta of the options exactly offsets the delta of the underlying asset in this, let's say stocks, so that the total delta is if the price of the stocks changes, the gamma shows how much of an impact this will have on the option deltas with time from deltas can change quickly. And portfolio that is current delta neutral may not stay that way for long. So what you have to do here is you may find yourself in a position where you might have to be constantly rebalancing your portfolio to make sure that it stays delta neutral. Now, delta neutral is designed to make it risk-free. Let's say you own a bunch of stocks, and you don't really want to sell them, but you're expecting a lot of trouble coming up, let's say over the next month or so. And so in order to avoid having to sell the stocks at a loss or whatever, you can just buy some options that will force the delta of the entire portfolio to zero and, basically ride out the storm, so to speak. And while all the trouble is happening, your position is protected. But the number of options you need to buy to do this and change depending on the size of the gamma. Okay, so in other words, if the market is really bouncing around, um, the deltas can be affected. And all of a sudden, when you think you're at zero, you're now suddenly a positive number or a negative number. So the deltas are designed to help us understand how sensitive our deltas are to changes in market conditions. And it alerts us to the fact that we may have to rebalance the portfolio from time to time. Sometimes if we buy the right securities, we may be able to make the portfolio both gamma and delta neutral at the same time. But that's tricky to do. That requires us to solve simultaneous equations, and we have to find the exact right combination of options. But it can, in principle, be done. Okay, but normally a portfolio might be delta neutral, but the gamut is giving us a sense of how likely it is that we'll have to rebalance it. Okay, so the gamma and the delta, again, the most important of all the Greeks. Now, these three have their roles, but they're not quite as important. Now, one thing I do want to point out here is this. And we mentioned this earlier. When we're looking at, let's say, a call, so we know that there at market maturity, the market price curve is going to be to the left of the call payoff. And what accounts for that is this. Let's say this is my stop price. I'll put S star. And why don't we throw some actual numbers in there? So what is this call? The strike is, let's say, $100, and the stock price is 105. All right. So what that means then is that the option is $5 in the money, so to speak. In other words, it's the payoff. If we were able to exercise it right now, um, and we may not be able to, it's a European option, we'd get a payoff of $5. Fine. So you would think that the option would sell for $5 in the market, but it doesn't. Instead, the price is up here somewhere. Let's say that's 8. So how come you're paying $8 for an option with the payoff at this point in time is only 5? Well, what you're paying for here is the option's time value. Okay, and what that reflects is the possibility the option could move further into the money by the time the expiration date arrives. So you're paying for upside potential is what you're paying for. Now, what's going to happen though is this. If let's say time lapses and now let's say our new market price curve is let's say here. I'll call that the new market price. Say a couple months goes by. Well, if you notice, all of a sudden, options selling for $6. And so what you're seeing here is that after time elapsed, in this example at least that I just made up, time value has declined from $3 because as we get closer and closer to the maturity date, the probability of the option gaining in value is shrinking. And when we reach, as I said before, on the exact final day of trading, the market price curve and the payoff profile are exactly the same, which means the time value is now zero. Okay, so at maturity, the market price curve sides with the payoff profile, which means the piecewise continuous curve. So that the time value of the option is zero. This is what you'd expect. Okay, so this curve, this payoff profile, it's sometimes said to be piecewise continuous. There's two distinct regions, both of which has a distinct slope. And you can see that with this sharp kink here, if we were trying to take the derivative of this function, it would be undefined at that kink. Okay, so it's piecewise continuous because it's basically two functions patched together at that one point. And so this is how the payoff profile behaves because that's how options are defined. The market price curve is a smooth, continuous curve, but they get closer and closer to each other. And on the final day of trading, they are the same, and the time value is going to be zero. So in other words, market price of the option will be the payoff. Okay, so in this case, if nothing else changes, like in other words, the stock stays where it is, price and payoff will both be $5 at the maturity date. Okay, so what was all that about? Well, because the theta measures quickly the time value of the option decays, as it's called, as time elapses. Okay, notice how fast is this happening? How quickly is my option losing value because of time? Right, that's what it's here for. Now, the formula for theta is really a nightmare. I mean, you can see it's going to be defined as partial c with respect to t for time, and this is partial p with respect to time. They're both going to be negative, except there's one quirky case where it's not negative. If you look carefully, when we had that graph, let's go back to the last section. 6A, that is, B rather. If you look at this graph, this is the the European put. Okay. European put has this very peculiar feature that if the put is very deeply in the money like this, there's a region in here where we're actually losing money because time is, the option is European, so it's preventing us from exercising early and investing the proceeds, which is what we would like to do. And so because of that, there's this very narrow area in there where the market price is actually lower than the payoff. But this requires it to be extremely deeply in the money. And what's going to happen is as time elapses, this curve moves in this direction. But up here, we're moving in this direction. So it's going back to the curve, the bell profile, but from opposite directions. So within this region, data is actually positive. We're benefiting from the passage of time because the black curve is moving up to the red curve. Okay, and that's what we're going to collect at the end. So other times, all the other cases, data is negative. Okay. And by the way, within American options, it's not going to happen because of the fact that we can exercise early. This is, I should have labeled this. This is a European put. With an American put, because you can exercise early, you won't run into the situation. So let me just quickly sketch that out. Oh, yeah, let's not use green here. Okay, where did I go? I'm going to just copy them. I need them to be identical to each other. No, oh, I need some curvature there. That's good. Okay. All right. So now that you can see them side by side, or top to bottom, I guess. Um, okay. So in other words, so theta is negative, the normal negative, as long as the red curve is outside there. And then it's only positive in this small region. And of course, that whole area is probably exaggerated. It would only probably be just in reality, way just this part in the upper left-hand corner. But anyway, down here, no matter where we are, the theta is negative, which is what we would expect. Okay, because the red curve is getting closer to the black curve, and the time value is shrinking. So remember, theta positive would indicate that the time value of the option is actually growing. But that's not normally the case. And there will be zero at maturity. Okay. All right. So, yeah, I mean, we have this form, but you're not going to be expected to write any code with data. But here it is if you're interested. Yeah, you can see it's kind of a nightmare, but there it is. And so here, for example, we have this, we actually had this stuck earlier. Um, $50, actually it was an option where the strike is $50 and the stock price is 52. And we went ahead and calculated the call price earlier as 764 approximately. The theta worked out to be negative 3.44. But now here's the thing about theta. Theta, when we do it this way, is expressed on an annual basis. We normally express it in the markets on a daily basis. And when we say daily, we mean like per trading day, not per actual calendar day, because the options don't change over the weekends when they're not trading. And so only the trading days are open. So what this says to me is that every trading day that goes by, the market, the time value rather, is declining by about 1.365 cents. And if you do the same thing with the put, in this case, it was negative 254, which means you're losing on a daily basis about one cent. Okay, now this is what the graphs look like. And you can see it's kind of like an upside down gamma. The sensitivities, the Greeks tend to be most sensitive when we're right around the strike price. That's because we're sitting on the fence between the option functioning in and out of the money. So there's more uncertainty there. Okay, this is right around where the strike price would be. And then for the put, if you notice, they're basically reverse from left to right. Okay. Right. And then they all eventually, um, so the at the money grows as we get closer to the maturity date. If the option is still right at the money, theta can actually become extremely negative, but eventually it has to go to zero when the option matures. Now, there you go. Now, here's an interesting one. This one revolves around the sensitivity of options and volatility. So, and I think I mentioned yesterday, Vega is not a Greek letter. So, we don't know what happened there. So we have to pick another letter so that we can use the symbol. So usually that letter is lambda. So in other words, even though we know perfectly well there's a lambda, we often see this used to represent Vega. Vega is not a Greek letter. It's actually a star in the constellation Lyra. So I think somebody must have chosen it just because it sounded cool and it started with V. But it's the sensitivity with respect to volatility. Okay, now may not be obvious, but options, and that is both calls and puts, both benefit from flexibility. Okay. So in other words, now stocks usually don't. Stocks don't really appreciate volatility. Like volatility really means that the markets are let's say there's a lot of uncertainty in the markets and people are nervous. We don't know what to expect. Oil prices maybe are spiking up or interest rates are heading up. Bad news is coming from all over the place. That's when you tend to see a lot of volatility. And as a matter of fact, let me show you something interesting. Um, the VIX index, or VIX simply means volatility index. So I call it the VIX index, we're actually calling it the VIX volatility index. But it actually was created maybe 30 some odd years ago. It reflects the volatilities of Standard & Poor's 500 options. I know, Chris, you know that this is one of the major stock market indices, so it's meant to capture the behavior of the whole market. And so let me show you what it looks like. And so we're going to go to this very special website called FRED. It stands for Federal Reserve Economic Database. It is being run by the St. Louis Federal Reserve Bank. And it's set up to give you all kinds of free information about economic variables. So all you have to do is come in and say, please show me the VIX. And you pick the one you want. And come back and say, look at this. Here's your VIX. Now, this firm goes back to 2020, but it goes up and down. And so the idea here is that it spikes up when things are going badly in the markets, and it flattens out when things are going well. Okay, because things aren't going so well, markets get nervous, volatilities go up. Speaking of start it's not letting me go back to the beginning, but it is, oh, here we go. 1990. So you can see these gray bars are recessions. or other crises like the COVID. And during those times, this volatility index goes to the roof because again, people are nervous. And so there's a lot of turmoil in the markets. So when this is happening, options will benefit in value, they'll both gain calls and puts, whereas stocks tend to take a bath while this is going on. Also, interestingly enough, gold prices tend to go up when the markets are in turmoil because when people are nervous, they turn to gold. It's always been perceived as a safe hedge against catastrophe or inflation or whatever. So the VIX is a good indication of how much volatility there's in the markets. Now, why is volatility so helpful to options? Well, and that's because remember, with options, the calls and puts, the investor has unlimited potential profits, limited losses. Losses are limited to the price paid for the option. But there's no upside maximum. In other words, if you own the rights option, let's say you buy a call on gold and it spikes up to $4,000 an ounce, that's all going right in your pocket. But once the gold price falls below the strike, if it got zero, it doesn't matter how far down the price goes. And so it's that asymmetry that drives the relationship between volatility and options. So let's put it this way. Higher volatility adds to the probability of an asset price increasing significantly and decreasing significantly. Um, so now, how does that help options? Because look what's going to happen. All price increases in the asset will add to the value call. Price decreases, no matter how much they are, can only reduce the value of the call to zero. And then, of course, this works in reverse for puts. All price decreases, the asset will add to the put. Price increases, reduce the value of put to zero. So that means is that on balance, the benefits of higher volatility will always outweigh the costs of higher volatility. Right. So again, it's because when it goes down, once it goes below the strike price for a call, it doesn't matter how much further it goes, you're still going to have a payoff of zero. On the upside, every time the price goes up by $1, that adds $1 to your payoff. So you're continuing to benefit from higher prices. Once you reach your limit on the downside, that's it. It doesn't matter how much worse the price gets. So in other words, because of that asymmetry between gains and losses, volatility is actually helping options, whereas they might hurt stocks, and they usually do. Stocks don't do well when markets are volatile. At least most of them don't, not all of them. There's always some stocks that benefit from volatility. It depends on what business they're in, but in general, the markets do not like volatility. They want things to go well, smoothly, predictably. Things, lots of good news. Volatility is bad for stock markets, at least. Anyway, that being the case, that means that these two will both be positive. Now, here's the interesting part. Well, there's a couple of interesting things here. They're both the same, just like with the gamma. They're both the same. As long as it's the exact same option, same price, same asset, same everything, they'll be the same. Not only that, but they're always positive. And the graph, when you see it, may even remind you of the graph for gamma. Although the scale is different. You see, it does look a lot, except with the gamma, the numbers and the axes were quite small, like 0.03, 0.02, numbers like that. The vega is a much larger number, although it is interpreted differently. But you can see it does look a lot like the same. And not only that, of course, as usual, it peaks out right around the strike price. That's where the value changes the most dramatically. In other words, the impact of volatility is greatest when the option is right at the money. So, but no matter what's going on, the vega converges to zero. Um, so let's see. I think that's all we needed to say about all the vegas. All right. And so the lesser is row. Now, row apparently, I mean, you notice that chart in Wikipedia didn't even mention this one. That's because this refers to the sensitivity of the options to changes in interest rates. And they don't really change very much within a given. I mean, yeah, it's possible the Fed will raise rates or cut rates, but interest rates are quite stable compared to, let's say, volatilities, which can change quite a bit from one day to the next. So these are the ones who probably would have the least impact on your options of all the ones that we've mentioned. By the way, here's the Greek letter rho. You normally see this used in statistics to represent correlation. But these are not equal to each other. In fact, they have different signs. Rising rates are helpful to calls and they're harmful to puts. Okay, and the graphs, let's see where the graphs are. Oh, well, boy, doesn't that look a lot like the call delta? It really does. In fact, you notice how the slopes are the same. It's the same thing as we had with the call deltas. We have positive numbers here for the call, negatives for the put. So if there was some higher order Greek that was based on the sensitivity of rho to changes in the stock price, it would be the same for both calls and puts. I don't, maybe there isn't, but those higher order ones that are just would be used for incredibly specialized situations. They're not the ones that are being used by most traders, depending on what they're trying to do with their positions. All right, so I think that's enough of the Greeks. Now we can move on to really um, after Black-Scholes, this is really the most important discussion we're going to have because this is where we finally learn how to price American options. Okay, we're going to use a model that was called the binomial option pricing model, and as the name suggests, it is related to the binomial distribution in statistics. And that's because the framework behind this, we can take a bit of a detour here, is based on the logic, or at least the original version of the binomial option pricing model, which was published by three researchers named Ross in 1976. Now, what's interesting about this, the Black-Scholes, the authors of Black-Scholes, they're academics. Okay, Black, I think, was at MIT. Scholes was at Stanford, and Merton was at Harvard. And so, being academics, they're not doing this to make $1 million. They're trying to write these interesting papers that could be beneficial to the readers. And the same thing is happening here. And so later on, Black and Scholes admitted that, and Merton, that they had no idea how important their paper would turn out to be. They just thought, this is interesting. People might like this. And in fact, the original Black-Scholes paper was rejected by 8 journals before it found a home at the Chicago Journal of Political Economy. Okay, which is not where you expect to find something like that. But this one too, these guys, the purpose of this paper originally, this paper was designed to show how the Black-Scholes model works by breaking up the path followed by the underlying system into a series of discrete steps. But based on the same statistical assumptions built into Black-Scholes model. So remember, at some point we discussed all the assumptions that Black-Scholes was based on. In particular, the assumption that returns to the underlying asset or stock, as it turns out, are normal, underlies the CRR. We're going to call it from now on CRR. So what they did is they took advantage of that limit binomial distribution verges to normal distribution. It's like you may have never had statistics. What's happening here is that with the binomial distribution is based on the assumption that a series of independent trials is taking place. The trials are independent of each other. And even more importantly, and on each trial, there are only two possible outcomes. And they're called success and failure. And the probability of success or failure, for that matter, remains constant throughout the trials. Okay, we have enough trials, the distribution converges the limit to the normal distribution. So the probability, so the classic example of this is suppose flipping 10 X will be defined as the number of bits. Then X is a binomial random since the trials are dependent. Each flip will only have two outcomes. And the probability of a head or success is a constant throughout the experiment. Then the probability of X having any particular value will look like this. We'll call this, usually the textbook has a capital X and a lowercase x. Capital X is the random variable, the lowercase x is a specific value. And of course, you recognize the factorial operator. And the number of trials. It probability of success. X the number of successes. Okay, so that's the binomial distribution. Okay, and as we keep increasing the number of trials in the limit, you'll see that we're creating a normal distribution. All right. So anyway, so what contrary to what we're seeing is taking the path followed by the stock, and we're breaking it down into discrete steps, which basically could be thought of as trials of a binomial experiment. And so what they're doing is they're showing how this model reproduce Black controls results for European options, but then it could be extended to also price American options because all of a sudden, here's a big deal. Can be used to replicate actual prices for European options. And in addition, um, price American options. Now you might say, well, how is it possible? Well, because all of a sudden, with this framework, it is possible to determine each point in time whether or not the option should be exercised. And that's what we need to price an American option. That's not possible with Black-Scholes because the way their model's set up, they don't actually tell us what's happening between today and the maturity date of the option. They're telling us, given today's data, what's going to happen on the maturity date of the option. There's nothing in between, basically. So we're jumping directly from today to the period when the option expires. And at that point, they give us a probability distribution to figure out the value of the option, but there's nothing in between. Here, they're showing us exactly how the stock got to its final destination. So how are they doing this? Well, this is where it gets very intense. So let me just show you a sketch out what they're trying to do. So you got, let's say here's your stock, S. We're going to assume that starting today, which is time 0, here's our stock price. Well, let's illustrate this with a node, as it's called. It can go up or it can go down. That's all we have. If it goes up to a multiple of itself, US. If it goes down to a different multiple of itself, D for down, U for up. And at least in the Black and the Cox-Russell-Rubinstein model, U and D are inverses so that their product is 1. If we go out one more step, we can go up to U squared S, down to UDS, up to UDS, or down to D squared S. Now, because these trials are independent of each other, in other words, each time step could be thought of as a trial. What this implies is that UDS and DUS are the same element. In other words, we go up and then down. We need more room than that. So in other words, up and then down is the same thing as down and then up. Okay, now that's a conscious decision, by the way. It doesn't have to work out that way. To minimize the amount of calculations that are needed. But that means that the tree as it's called, by the way, this structure we're creating is called either a lattice or a tree. A sideways tree, actually could look at it where the root is S and then it goes up and down. It's like imagine a huge tree falls on its side. It would look like this. Um, since U and D are inverses, and actually that's another interesting subject. Increasing and then decreasing brings us to the same point as increasing and increasing. The tree said to be recombining. And furthermore, UDS is the same as S. That means we're just right out. We started from. So this is it didn't have to work out this way. This is a conscious decision by Cox, Ross, and Rubenstein. Later variations of this model do not follow this same approach. They allow for the idea that maybe going up and then down was just to a slightly higher point than down and up or that kind of thing. But here, just to keep things simple, up and down is down and up. It's the same thing. And then if we go up and then down or down and then up, we're actually right back where we started from. So the question is, first of all, what are the values of U and D? And secondly, how do we know the likelihood of going up or down on each of these steps? So they will develop this very complex framework based on the Black-Scholes analysis and show us that U and delta T is the time between the steps, which is a constant. Okay, those let's say every day, every trading day, or every week, whatever. Um, and yeah, it doesn't have to work this way. There are more advanced models where this isn't necessarily true. Of course, this is a volatility, and then implies it. This must be the case. All right. So that's the U, that's the D. Now, what about up and down? Well, in order to fill in this model, we need probabilities for getting up and down. And that's where all the complexity comes in. All right. So I guess we can put this away. Let me jump ahead a little bit and show you the formulas real fast, and we'll get back to later on where they came from. There's a lot of theory going on here, which we may not have time to get through it all, but here it is. Give it a minute. Let's give it another minute. Here we go. Okay, here we go. Now, of course, these two have tips. One, there's only two possibilities, up and down. And everything here we defined so far, U and D, we know they are R's, the risk-free rate of interest. Um, And of course, delta t is the size of the time step. Those are my probabilities. Now, what about the option? Right now, all we're doing was modeling the stock price. What about the option? Well, here's what's going to happen. It's implied law that the P never changed. We don't have to keep labeling it all over the place. P means the probability going up, one minus P means going down. So we're going to also need to define a tree for the option price. Now, in Hull's book, he comes up with an interesting idea. Hull's book, which this whole course is based, uses the letter F in stand for option price in this framework. Why is that? Since P could be confused with a little bit of the movement. So we're going to get avoided getting equal that. Once we know whether there's a call or a put, we use the letter F, and then from then on, that means it's either a call or a put, depends on which one we want. We're not going to use P here. Instead, we'll just use F for both calls and puts. So the tree looks like this. Now, here's the notation can get a little confusing. The up and downward movements in the option tree are not necessarily multiplied by constants like in the stock tree. So what Hull does is he writes this as F with a subscript of U and F with a subscript of D. So you have to be careful of that. These are not multipliers. This is F sub U and F sub D. And then that means that here we have so once we have our stock price tree in place, we can use it to fill in the option tree. Now, we're going to do this not from left to right, but from right to left. Believe it or not, we're going to start in the future and work our way back to the present. Because let's say, assume that this option, just to keep it simple, matures at time t equals 2. That means, remember, the family's option is now at t equals the option expires. And so the value of the option, as we just discussed, at maturity equals the payoff. Right? Remember, the payoff and the market price are identical on the maturity date of the option. So let's keep things simple. Let's assume that this is call. The payoff, as you remember, is max s minus x and 0. So that means here, but instead of writing s, we're going to write numbers on the stock tree. So instead of s, we put u squared s. Okay. And then for FUD, we don't know yet. I mean, we will when we're doing this for real, but right now we don't know what the values are on the stock tree. And so we'll write it with this. So there's the first step is fill out the payoffs at the maturity date. Then what do we do about the earlier values? So These are all, by the way, collectively known as terminal nodes. Nodes of the dots where we have a value, by the way. That we have nodes and we have branches. We're using that tree metaphor. Branches and nodes. These are all collectively known as the interior nodes. And that's where it gets interesting. So what's going to happen is this. Start with FU. Now, keep in mind the value of this option at time equals one occurs 1 year or one in this one period, whatever, before FUU and FUD are determined. So since at FU we can only reach up to FUU or down to FUD, the entire value of FU is determined by these two. Okay. And so it's going to be done like this. So let's break this down a bit. So in other words, there's a P, probability of moving up is P, down is 1 minus P. If we go up, we'll reach FUU, and if we go down, we'll reach FUD. This is the present value of this, which we can think of as the expected payoff. Period. So in other words, what we're saying is that the expected payoff is the payoff so it's expected payoff, I should have said next period or time t equals 2 in this case, is the weighted average of two possible payoffs at time t equals 2, weighted by probabilities of reaching those payoffs. That's the expected payoff, but we still have one more thing to do because that payoff is next year or next period, whatever the case may be. The value of FU today is the present value of that payoff. So FU, the option price at t equals 1 is the present value because the cash was occurred or the value will be at this level in one time period. It's the present value of the expected payoff at time t equals 2. So in other words, now this is logical follow through the rest of the tree. It means FD, if you notice that FD, we can only reach FUD and FDD. Therefore, let's see what we can do there. So you can see it all at once. So you notice what's different is that the nodes that we can reach next period are, if we're already at FD, we can only go up to FUD or down to FDD. Uh-huh. And then that implies that the price today, oh, I'm sorry, I just realized I made a mistake. This should be FD, not FUD, FD. And then, so these two are already done. So these are done. And that just leaves the price today of this option. This is what we're looking for. This is what we want. F would therefore be Okay, so from here, we can only reach up to FU or down FD. So that's where we're going to get this value from. And so this is a final result. You can see there's a lot of calculations going on here, a lot of calculations. But this is the final result. And if F is a put, we only have to make one change. Right? In other words, so I just reverse the X and the S. Okay. And then the rest of them are filled in exactly the same way. Okay. The interior nodes are filled in the exact same way as for the now this is a two-step model. There's a third step, and each time you stretch it out a little further, no matter how many times that's slower. The option equals payoff. The interior nodes of all good effects. The present value of the expected payoff of the next period. Okay, so in that sense, it's the same. Now, what I just showed you here, this entire framework that I just showed you only applies to European options because what's happened here is we have not considered the possibility of early exercise. So far, all of these examples apply to European options as they do not allow for early exercise. How do we take into account early exercise? That's a very good question. Now that of course depends whether to call or put. So basically in a nutshell, here's what's going to happen. The value of the terminal nodes are not affected. They are always to the payoffs check at maturity. For the interior nodes, a decision has does it make sense to exercise? So we'll assume that the investor will exercise because we're assuming that these are rational investors, they're always trying to maximize their profits. We can avoid, we don't not worry about people who don't know what they're doing, but so in each node, the option exercise payoff is compared with value option if not exercised. In other words, the present value expected trade where the two. All right, so let me just quickly sketch this out for you. An American call, two period American call. So that nothing's changed so far. Now the fun begins. FU. So so here's yeah. Let me. I think the best way to express this is to probably show that the two values, one if exercised early and one if not exercised early. So it's the greater of um no, this is what it would be worth as a European option, meaning even if it's an American style option, if we do not exercise early, this is its value. If on the other hand we decide to exercise it, it's the payoff of that node. Now remember we're at FU right now, which means stock tree has a value in US. Okay, you see there, this is US, which corresponds to this node right here. So the greater of the two is what goes on that node. Uh-huh. So FD is the greater of, move down a node. That's this node. Remember, at this node, the stock price is now DS. So it's either that one or, all right. And then that just leaves F plane or left. What do we do here? Same thing. Oh, I forgot to label this one. There you go. Now for the put, again, the only change here is the value of if exercised. So let's try the American put. All right. So again, you immediately start by filling out the payouts at the terminal notes, and then you fill in the interior notes by comparing the value if not exercised early with the value if exercised early. Right. So for example, if you right. Oh, wait a minute. Sorry, I just realized no, it's where FU means we can reach FUU. My mistake. Sorry. Um, or FUD. That's better. This is UD. Right, because we can reach either one of these from FU. Um, but if we do exercise early, remember this note, the stock price is US. Then, based on the same logic, now we go down to FD and we pick the greater of. So from here, if we go up, we reach D, go down, we reach TD. And if we do reach this node, the stock price is DS. Okay. And then finally, F, the current price. And of course, if it's exercised early, all right, there's that. Now, what I'd like to do, maybe not right now, maybe in the next session, before we go on to something else, I'd like to just give you a brief discussion about where does it come from? This is an important detail. The probability itself is extremely important in option pricing theory. It underpins the logic behind all derivatives pricing when you come right down to it. So I'd like to just take a bit of a detour and discuss where this comes from. And I'll give you a hint, it has something to do with arbitrage. So once that's done, I think we can move on to the next discussion, which is Monte Carlo simulation, where it's a technique for pricing what are called exotic options, whose properties are too complicated to price with the binomial constant pricing model, or certainly Black-Scholes. It is based on statistical assumptions of Black-Scholes. But now the good thing about Monte Carlo is a price derived options thing. not trade on a regular basis that have bizarre features. Bizarre features. The drawback is that it can be extremely time consuming. Otherwise, it would probably be used for everything. It's a very nice approach where it's not nearly as structured as what we're seeing here. It's very it's a good approach for very complicated cases, but if it weren't so time consuming, we'd probably see it used for other areas too. We're going to take a look at that as well. In fact, I think you'll find the whole thing very interesting. The simulation is it's quite an art form where you're drawing samples from some probability distribution and applying it to some model or other to come up with results. And so we'll see how that works, but it's ultimately based on black shoals, just like what we did here. So anyway, so it's getting kind of late here, so we'll stop here. And then the next time we'll wrap up our discussion about the binomial option pricing model. In particular, I'd like you to see where P is coming from, and then we'll take a look at Monte Carlo. All right. So I'll see you then.